after you know how to calculate the tax, then it comes to the real cash flow problem. So it's called after-tax economic analysis. Remember that before Chapter 7, all the cash flows we're talking about is we didn't talk about anything about tax or depreciation deduction. So we can assume that those are the before tax cash flows, okay? Or maybe they consider that, but they didn't mention that. But after Chapter 7, you need to focus on what is called after-tax cash flows, okay? And so usually the problem will give you a before-tax cash flow, and then you will be given the tax rate, and also the system where you can check the depreciation deduction. Usually you will be using the GDS system, okay? And then from that you can calculate your depreciation for every year, and then you're gonna take the depreciation from the before tax cash flows to have your taxable income for each year, and then you use the tax rate to multiply with the taxable income for each year, and then you will have your tax for each year, right? And then you take the tax out of your taxable income for each year, then you will have your after tax cash flow diagrams. So before we use that method, we need to look at this new concepts or terms. So the first one is RK, that is the revenues, or we can say that's the savings, okay? If you use some new equipment to save energy or save the fees, that is the RK from the project. And this is the cash flow. This is the cash inflow from the project during period K. And EK is cash outflows during year K for deductible expenses. Okay, so you have some income, you have some outgoing cash flow, which is represented by EK. And so K is for the year, okay, for period. Could be year, could be month, okay? And DK is the sum of all non-cash or book costs during year K, such as depreciation. Okay, so usually we use DK to represent the depreciation deduction for each year. And T is the effective income tax rate on ordinary income. So T is always given in the problem. And the capital TK is the income tax consequences during year K. So that's the tax you pay or you owe every year. And ATCFK is the after-tax cash flow for that year K. Okay, so those are just terms we use. And then we're going to use this table to calculate what is the after-tax cash flow based on the before-tax cash flow, based on the depreciation deduction system, and based on the tax rate, okay? So in this table, we have different columns. The first column is the number of year. So it's if it's 0, it is the end of year 0, which is at the beginning, okay? And 1 means the end of year 1. N means the end of year N, okay? And then and also you have 2 ends. So you have 2 last years, which means in some cases, the first last year row, you're going to write down the expense or cash flow in that year. And the last N row means you're going to write the market value, the MV, in case you have that. If you don't have that, this row is going to be, this cell is going to be 0, okay? This cell is going to be 0. And so that's why we have 2 N rows, 2 last year rows, okay? So that's the first column. And then the second column, we call it column A, okay? So column A is the before tax cash flow, BTCF. So before you consider all the tax and deductible, you have a cash flow, original cash flow. So it's made of what? It's made of capital investment, okay? And then for each year, and the capital investment always occur at the beginning. So it's in the row of year 0. And after that, from year 1 to year end, you will have some ordinary income or operation expenses. So it could be positive, it could be negative. That's all the net cash flow occur in every year, okay? And then in the end, except for those cash flow, you still have the market value if it's possible, okay? So this is the before tax cash flow, and we can use the PW method or the internal rate of return method to calculate if this project is a good one or a bad one based on the before tax cash flow. But it's not a real cash flow. Sometimes if your tax is significant, you need to consider that. So you need to focus on the after tax cash flow, okay? So to have the after tax cash flow, you need to consider the column B, which is the depreciation deduction column. So the first cell in column B is not available because we don't consider the deduction for the capital investment. So you don't have to fill this, okay? It's NA, not available. Or you can write a dash, or you can just leave it empty. And from the year 1 to year end, you're gonna have depreciation, okay? And in every year, okay? The depreciation, it depends on what kind of property you have, what class it is, and what is the depreciation, the recovery rate, okay? And what is the book value. So this is gonna be B times RK if you're using the GDS method, okay? Or in the problem, maybe you will be given the depreciation deduction for each year, okay? You just need to fill them up, fill the table up, okay? But you need to understand that those numbers listed here will be positive numbers. And then you will have the column C, which is the taxable income column. So column C is always the number in column A minus the number in column B. So whenever you have this equation in the column head, it's easy to calculate. So first in this first column, first row, it's still NA, not available. You don't have to fill it up. But from year 1 to year end, you need to fill it up with the number which is the result from A, the cell in column A minus the number in column B. And we say that is the taxable income because that's your gross income minus your depreciation deduction. Okay, so that's the taxable income, TI. And this number can be negative or positive in sign. And then don't forget about the very last row, which is to talk about the market value. And this is gonna be the market value minus the book value, okay? And then we need to think about the income tax, the column D, okay? Column D is minus T times C. So T is the effective tax rate. Okay, so use tax rate times whatever you have in column C, okay, and then give it a negative signal, negative sign. That is what you have for every year. So this is how you fill up this column. And then don't forget about the very last row. It is still the minus t times whatever you have in the column C. Okay, and then the very last column is the after-tax cash flow column, which is the sum of whatever you have in column A plus whatever you got in column D. Okay, so for this, the first row, you just copy the capital investment. Okay, and don't forget about the capital investment, the sign is negative. And then for the row of year 1 and year n, you're gonna use A plus D, the number in the column A to plus number in column D to fill this up. That is your after-tax cash flow, cash flows from operations. And then don't forget about the very last row. If you have market value, okay, it is still the MV, the MV in the column A plus whatever you have in this column D. Okay, so this is just a big table filled with equations and to teach you how to fill up this type of table. And then after you have this after-tax cash flow, you're gonna use the PW method or whatever method you learned from chapter 5 and 6 to calculate if it's bigger than 0 or not, to determine if this is a sound project or a bad one.